Good morning, good morning, good morning, and welcome. Depending, actually, good morning, good afternoon, or good evening, even. Sorry, don't know where I am. I'm just reading Jay Smith's morning. Well, it's morning, good afternoon, good evening, depending where you are on the planet. And welcome to today's slightly late running Tuesday, the 23rd of May, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. Usual run through in here today, what we've had, what we've got coming up. Take a look at the calendar. I'm going to do a little bit of a semi-teaching session here, talk about PMI in a little bit more detail. Given we've got the PMI data today, we'll also take a look at just general articles on the major news wires. Clearly, debt ceiling all in focus still, and we'll take a look at a dip into the charts. Let's start off with the data. We'll actually go back to yesterday. Yesterday was all about Fed speakers in here. So we had, Kashkari was up early on. We spoke about Kashkari, but we also had Bullard, Barkin, Bostic, Daly all up yesterday. And from that, if we look in here, that's Bernanke. Here we go, morning bid. So in here, Fed's hawks re-emerged, dollar pumped in here. So dollar liking the fact that there's a hawkish tone coming out of the Fed. And Kashkari, we covered it yesterday, said it may mean that we'd have to go north of 6%. Very, very, very hawkish in here. Bullard, though, also in here. Let me see if that's actually a separate article on Bullard. I was just talking about Bullard. Yeah, rates may still need to rise another 0.5 point this year. Right, so we're pricing in, not pricing in that at all. We're pricing in, although the market started to price in a little bit. If we go to the Fed Watch tool, once it loads, if we go back to June, in here, this is falling, right? This is falling, increasing risk of a 25 at the next meeting. And by July, look, there's even a glimmer of 225s over here, or a 50, right? And if you look in here between for July, we've got a total of 37% versus 62, right? So growing risk, nearly a 38% versus 60, just over 62. So a growing risk in here of a rate hike. We weren't really pricing that in at all. And if we go further out the curve, September now, rates still where they are, right? We were looking at cut, September, November, December on these three tabs. Rates pretty much where we are. If you look at the chances of being here where they are now or higher, there's only a 16.8% chance of them being down come September. Okay, now that was nailed on that we were going to get a cut pretty much for September. And if we go out to November, we are looking for cuts by November. But if we look in here, you add it up, right? Only a 53% chance of lower rates. So that leaves us over here with all of this is 40%, 47% chance of rates either here or higher, even come November and December. Now, if we add these up in here, so where are rates unchanged in here? So there's a pretty good chance we get the markets wants a rate cut by year end, right? If we add all this up in here, it's over more like 80%, only 20% chance are unchanged, but a good chance that we're going to be only 25 down by year end. I'm going to sneeze in a second, so excuse me when I do. Oh, there it is. Sorry. Sorry, guys. A growing, more hawkish tone being reflected from the CME tool. This is the interest rate futures market, the interest rate curve, remember, and that kind of echoing this kind of still a slow shift, if anything, towards in here from the Fed speakers. So Bullard there on the tape. So there is the hawks are coming a little bit more hawkish as we go forward. Let's wind ahead then to today. Well, overnight in here we've had Australian and Japanese PMI. There it is there. And then also overnight for you guys in the US, we've had this morning for me, we've had European PMI. Now, if you look at the Asian, the Australian, Japanese PMI, remember this is P. See the little P there? P stands for preliminary, or also known as flash PMI, preliminary or flash PMI data, and we're getting this out from S&P Global. I'm going to talk a little bit more about PMI as we go forward. Let me just cover off what we've had though. We've had some beating here out of Asia, Australia, and Japan there. You can see in here mixed. So we got to France. We've had misses on the composite and the services, but a beat on the manufacturing. From Germany, the composite and services beat, and the manufacturing was a miss. If we go to the Eurozone as a whole, miss on the manufacturing and composite, beat on the services, and then miss on the UK on all three, composite, manufacturing and services. So generally you'd say Asia looking okay, Europe mixed or negative, UK certainly negative in here on the PMI data. Now let me wind to talking about PMI, so a little bit of a teaching session. So PMI, the PMI data now is owned by S&P Global. They bought it from a company called Markit, Markit, about a year or so ago, 1 to maybe 2 years ago. They bought the data from them. And this is global data, right? This is global data. And the reason it's important, and just to scroll down on this page, I will share, let me just check it is on this page. Maybe it's not, no, it's on this page over here. In here. So this is like their homepage, which I will share with you. But the one that gives you all the methodology is this next one in here. So this one in here, and I'm just going to do a little bit of talking about this, a little bit of teaching sort of thing, a bit of education. So for those of you not aware, so this data in here is seen as really important, and I'll tell you why. Let me tell you why I think it's really important. First of all, it's what the data is, right? So what is the data in here? Well, if you go for the methodology in here, right? So it is a survey, first of all. It's a survey panel, senior purchasing managers, executives, or similar, around 400 companies. So it's kind of far reaching, right? That's not 400 companies globally. That's 400 companies per country, per economy. Okay, so it's a broad reaching survey. Okay, and it's senior purchasing managers and executives. Why is it important? And it's a survey, right? Remember, it's a survey. Yeah, and these are the questionnaires, right? This is what the questionnaire includes. On the manufacturing side, it's questions on output, new orders, new export orders, backlog of work, output prices, blah, 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 right? Services, business activity, new business, new export business, outstanding business, price charge, input prices, yeah, and so on and so on for the whole economy in here, okay? Construction, okay? So they've got different questions and different categories for different sectors of the economy. And the reason it's important, okay? So I worked at Credit Suisse for quite a few years. I was a director there. And I had a very esteemed colleague called Jonathan Wilmot, very senior. He was there for like 30 years or plus or something like that. He's even more ancient than me. And he, very, very super brain, massive brain, really super intelligent. And he him and his team devised a set of indicators that were called risk appetite indicators at Credit Suisse. And they were seen as becoming like an industry standard. Everyone wanted to get their hands on this data. And it was based around the PMI data, because what they did on multiple years and decades, I think, of back testing, that the PMI data was a really, really strong indicator of future economic growth and indication of future economic demand. Okay, so the PMI data was an excellent reflection for 1, 2, 3 months forward about where the economy was going to go. And obviously, the market tends to move before the actual economy by about the same kind of like timing, like 1, 2, 3 months before as well. So what we saw in here was this set of data called risk appetite data, based on the PMI data, was an excellent reflection of the future trends in basically bigger picture economic data, like growth data, demand data, unemployment data, inflation data, etc. So and the reason is because this is very reactive, right? This is a survey, right? And it's very reactive. It's going to be as soon as a company sees their orders going up or down, their prices going up or down, delivery time, stocks of finished good, inventory, all of that kind of stuff is all placed within this survey, right? So it's very, very reactive. Not like something like GDP, which takes ages to come through, right? This happens very, very quickly because it's done on the survey. And then look, questionnaires are completed in the second half of the month, yeah? And survey results are then processed by the economists, and then what we get is this flash PMI. Now there used to be, I don't see it leaping out at me, but the flash PMI data comes out, I'm pretty sure in here, well, I know it comes out a week before, so the data comes out usually the first of the month, yeah, or the first trading day of the month is when the final data comes out. But usually, I think it's a week ahead of there. So a week ahead, in a week's time, it's going to be the beginning of the month. So a week ahead of there, we get the flash PMI. So, and I think it's, don't quote me on this one though, I can't quite see it leaping out at me. I'm looking for the number 80 on the screen, but it's 80%. Once they have 80% or approximately 80% of the surveys in at this point, and then they put this flash PMI. So it's a pretty good indicator of what the final PMI data from S&P Global is. So, and remember, it's done then for all these different sectors, and where global coverage, we'll look at all these countries. This is all the manufacturing countries that are covered. Yeah. These are all the service sector countries and then the whole economy countries. So a huge amount of countries covered, nations covered in here. So significant and different sectors in here. Look at all the different sectors that are covered. Yeah, so it's covering the full economy. Okay, so it's really important data. So it's a really good lead indicator of where we're going. And this flash PMI data now. For you guys in the US, which is a lot of you and most of us are trading US products, right? The thing here is we do get the PMI data from S&P Global later today. Okay, comes out at 9:45. When we get the final data next week, okay, we get that again at 9:45 Eastern, and then at 10 o'clock Eastern, then we get the ISM PMI, right? So the ISM is the US Institute of Supply Management PMI. I'm pretty sure that's a longer backdated stream of data, okay? And for the US, that is more watched. So the S&P Global number comes out in a week's time, the final number, and the market tends to not react too much to that, and it waits for the ISM number and more reacts to that. However, remember, we have had the flash PMI, and it tends to be that the flash PMI, we don't get a big change from the flash PMI to the final PMI. Most of the moves in the market come on the back of this flash PMI data because there's not a big update when we get the full data released in 1 week's time. So even though the ISM number is seen as more important on the day when we get the final data from S&P Global, today we don't get a flash PMI from ISM. Okay, so this is the only data we've got, and this data we've had all through today from the various countries tends to be more indicative and tends to get a bigger market move than the final data, and in fact, as well, more than the ISM data. Although the ISM data does tend to move the market as well. So this data today is important. I know that's a long-winded way of saying everything, but I think it's important. I'm trying to do a bit of education as I go on some of these webinars. This data is important, and some calendars in here. So this calendar does actually put it as, we've got 3 bulls in here but only for the manufacturing, not for the services, and for the UK for some reason 3 bulls. Investing.com's calendar. Some calendars only have it as a market as a mid-tier kind of piece of data. For me, it's a very important piece of data, and it does move markets, and it is significant. So we will be keeping an eye out for that today, 9:45 Eastern, watching for that coming up today. And that's the real main focus for today. Nothing really of any significance coming through in here other than that. New home sales rarely makes, they've got that as a 3. New home sales doesn't move the market. I've been doing this a long time. New home sales, unless it's massively out of line, it rarely has a significant impact on the market, and it's not going to do anything today, going into the fact that we've got obviously the main thing. So moving on from PMI, the main thing we know 5 things started today. It's all about ongoing debt ceiling talks in here seem to be positive outcome. Both agreeing a default is off the table. So it's the message Janet Yellen continues to be yelling. Yellen is yelling that potential for default and how disaster it would be. I just don't think it's not going to happen in here. Scenarios range from the benign to the dangerous. JP Morgan's Jamie Dimon warning of a market panic on Bloomberg TV earlier this month. Well, yeah, but until we get close, I've seen this before go really close to the wire, down to I'm sure it was in the. I was at Credit Suisse, so I think it was in the, around 2010. I think it went down to 1 to 2 days. I'm going to do a little Google search on that. But it's really gone down to the wire in the past. It's used as a political chess piece, a political pawn for the non-incumbent to get through what they want. Obviously, the Republicans are trying to get an increase in defense spending, yada, yada, blah, 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 right? But they're going to get it done, right? I see less than a 1% chance of this not happening. And obviously, the market believed that because last week we had a significant breakout with the S&P having been paralyzed for about 2-3 weeks at least, and you could argue 1 to 2 months. We had a big breakout to the upside. The Nasdaq continues to go higher. Big tech is leading the way higher. So and it covers it here. Look, US equity markets continue to buy the bears as total purchases in the past 2 weeks, the fastest pace since October. The market is getting long, I think, slowly. The market is getting long, and I think you could see another big push into longs if we get the once the debt ceiling is passed. I think we'll get a big spike higher in here, and we could see a significant. It might then leave us with a sell in May and go away scenario, right? It could be kind of get quite quiet, but I think we'll get a significant spike to the upside before that. This is covering what we've already spoken about: Bullard and Kashkari. Kashkari being particularly hawkish over the last 24 hours, and markets are fairly flat in here. And Nasdaq did manage another new high yesterday, did actually nudge to another new high. Most markets are fairly flat. Oh, we got Logan. I didn't see that. Logan at 9 o'clock, it's telling me here. So we're watching out for that. And the PMI data is the bigger focus. What else do I have you in here? So that's the article around Bullards. We've already covered that. Bernanke has been chatting, obviously, ex-Fed chair. The Fed needs to cool off the hot jobs market. Yeah, the jobs market is staying really strong. It stays a tight market, rebalance the labour market. But, they're trying to do that, obviously, with the higher rates. Treasury yields continue to go higher. And I think, it's testament to how strong. So we go and look at Treasury yields in here, continuing to push higher in here. Let me just pop this one a bit bigger. So look, we're back on the highs, even higher. It's closed on the highs yesterday, even higher yields today. Highest point, and this big sell-off in here, or not sell-off, this was a rally in bonds, so a sell-off, a move lower in yields. This was during the banking crisis, right? We had a big push lower in yields. So we're getting back up to pre-banking. This is the banking crisis, pre-banking crisis levels up here from the beginning of March, okay? And this move lower in yields was on the banking crisis through early March. So we're getting, starting to nudge into levels not seen since the banking crisis. So high yields, but despite that, just to quickly jump onto the to the chart in here. Oops, log me out. One sec. Let me log back in. Bear with me. The Nasdaq, which should be heavy in a higher yield, higher interest rate environment, continues to push higher. Another pretty much a high close yesterday or close to, and we made new intraday heights overnight and this morning. So that still continues to look bullish in here. I'll have a dip into here in a second, but nothing to add. That is still super bullish in here. There's Bernanke. There's Treasury yields continue to climb. I've talked about PMI in here. European markets kind of mixed in here after that data this morning. So no real big shakes in there. Actually, the CAC notably lower. And just one other thing in here. So Japanese data in here was a 7-month expanded for the first time in 7 months. So that's a reading above 50 for the Japanese manufacturing PMI. So positives coming out of Asia, and oil in here kind of a little bit sideways in here as we go through. It was actually up a little bit this morning, but sitting and pushed higher yesterday as we continue to be in this slight risk on mode, despite the fact risk on mode, despite the fact futures slip. Well, they didn't slip that much in here. What else do I have for you? US debt ceiling crunch threatens to roil. Yeah, I mean, I think, it says US debt ceiling crunch threatens to roil. Well, yeah, I mean, if they default, the market's going to get absolutely, smashed. I mean, it's going to be like a mini crash, right? If they don't get it through, right? Because a default would be a disastrous scenario for the bond markets, for everywhere, right? And for the global economy. And it will take years for them. It's not going to be a matter of then, okay, they then pass the debt ceiling and then they pay because the damage will be done, right? You can't have that blot. Once you get that on your CV, as it were, once you get that negative on your what do you call the CV in the States? Resume, right? Once you get that on your resume, right, it's no good. The US hasn't done a proper default for, well, they have like sort of quasi defaults in the past, but nothing any time recently, and so it will be a disaster. They almost certainly lose their AAA rating, and it would be a big negative. But the chance of that happening, and it's not priced into the market. The market is pricing in that it's going to be done deal. And you probably see an initial rally. You probably get a buy the rumor, sell the fact, right? So you get probably initial rally if and when it's done, and then the market will probably sell off on that day. So be ready for that, guys, as well. Be ready for that. The market will likely spike on the day when it goes through. If it's today or tomorrow or whenever it might be, it will likely spike and then sell off. And again, Yellen's shouting about June the 1st. I think I saw an article yesterday from Goldman. They were saying I think the 7th or 8th. There's been other numbers in the middle of June as well, but we're continuing to get June the 1st as like the sort of semi-deadline that we have in here, and we've already spoken about oil. We'll look at that. Let's have a quick look at the charts. Not going to spend too much time in here. This just looks like a flag to me, ongoing flag, right? We kind of broke to the upside out of this flag yesterday. All the trend lines you can see coming up in here. This is the Nasdaq, all very much intact. We have trailed back lower in here, but I'm just looking for have a little internal trend line I would have down here. A little trend line just running down across there, down, not from the actual spike high, down across there, and it break above there, even above like 13,915, certainly up through 13,935 would look bullish for NASDAQ. Let's take a look at the S&P. Again, kind of flagging in here, flag pattern going on. You know, if it cuts down below here, that could be a little bit of a worry. You've got like this line comes across here. Ooh. It's like playing with it now, right? But, you know, really it's only been these two lows in here. It's only back down through yesterday's low, 91, and then the prior low, 86.5. It starts to look a bit ugly, you know, if it gets down through there. And it's unlikely to do that, you know, ahead of any kind of, you know, news. You know, I think we're going to be trapped in here before until we get some kind of resolution. But we could get a breakout either way on the PMI data. So watching out for that PMI data could give us a little breakout either way. So watching through that data. And then nothing really more to add on gold and oil. Gold continues to look heavy. You know, we had a rebound back in here on Friday, a little stall, a bit of a non-day yesterday, down in this morning, and looks like, you know, wants to challenge the low from last week at 1954.4, and that little low there is 1953.7. Down through there would look far more negative for gold, looking heavy. That stays heavy. Oh, and I've got the wrong contracts in here for oil. Any oil traders out there? Where are we now on oil? What's my front month? Let me go and take a look. And right, are we on July? Is July the most liquid? I'm not an oil trader, so I'm just looking offline in here across futures markets. Oil, yeah, July, I think, is front month, so N. Okay. And I'll do that one again. I should close these down so we don't have those. Okay, let's take a look at oil on the daily, first of all. For me, this still looks negative. You know, in my reports, I've stayed negative. You had this big sell-off, it rebounded, failed, and then last week, I think, you know, they had this doji pattern in here. You had another doji pattern yesterday. It's kind of indecisive, but whilst capped below these two peaks here and here, I think it stays negative. But we are nudging higher. I'm just kind of hanging on to a negative. But if we do get a positive on the debt ceiling, you know, this is going to break to the upside. It's going to be a risk-on event, you know, so you're going to see it break to the upside. So, you know, even though my equity view is positive, this looks heavy from a technical perspective, but I think it would need to really push. If we zoom in now, in here, oops, let me just zoom in here. See, what line was I looking at doing on here? I'm looking at this line in here from here. So from the 15th, like through the 22nd. So let me see what that looks like on here. Oh, I've still got the daily on, that's why. Let me just take this to a 30-minute. Okay, this line across here. I mean, you could, to really switch to more negative, I think it needs to go down. Whoops, that's no good. Let me just cancel that. Where am I? This line off the low here. Taking it through here because you've kind of got a breach of it here, and then it rejects the breach. So down through here, it's probably down through this little low here, looks more negative. So 71.34, but, you know, it really needs to take out these peaks up here and over here, up through 73.57 to be more bullish. Otherwise, it's kind of no man's land. All right, guys, so I'm going to wrap it up there. Any questions? Please throw them in the chat now, or if I have hold your peace. Anyone got anything for me? Feel free to ask as we go, guys, you know. No? Okay. All right, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. Watch out for that PMI. Watch out for a potential announcement on the debt ceiling. And I'll be back with you with another bull versus bear webinar tomorrow. Cheers, guys. Bye.